Have you ever experienced that sinking feeling when you enter a trade with perfect conviction, only to watch it immediately move against you, forcing you to question everything you thought you knew about timing? What if I told you that the difference between turning a perfect setup into a massive win or watching it crumble has nothing to do with finding better entries, but everything to do with a timing strategy that most traders completely ignore? You see, there's a fundamental misunderstanding that plagues the trading world. Traders obsess over finding the perfect entry point. They study charts for hours, draw countless lines, analyze indicators until their eyes blur. But when that moment finally arrives, when they think they found the holy grail setup, they make one critical mistake that destroys their potential for massive gains. They go all in. They commit their full position size right from the start, convinced that their analysis is bulletproof. Has this ever happened to you? But before we begin diving deeper into this game-changing timing strategy, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Now, here's what nobody tells you about turning perfect entries into massive wins. It's not about being right from the start. It's about what you do after the entry that determines whether you'll capture a small profit or a life-changing gain. The legendary traders who built fortunes didn't do it by swinging for the fences on every trade. They did something counterintuitive, something that feels almost uncomfortable when you first hear it. They started small, incredibly small, almost laughably small by most traders' standards. Think about it. When you enter a position with your full intended size immediately, you're making a declaration to the market. I know exactly what's about to happen, but the market doesn't care about your confidence. It doesn't reward your conviction. It only rewards those who listen to what it's actually doing in real time, not what they hope it will do. Stay with me until the end of this video, because what you're about to discover might completely transform how you think about position sizing and timing. The timing strategy I'm going to share with you treats every entry as a test, a probe into the market's true intentions. It's a method that allows you to participate in massive moves without exposing yourself to devastating losses. It lets you build positions that grow like a snowball rolling down a mountain, gathering momentum naturally, not because you forced the trade, but because the market itself invited you to scale up. This approach has been used by the most successful traders in history, yet it remains one of the most overlooked principles in modern trading. What makes a perfect entry turn into a massive win isn't just identifying the right moment to get in. It's understanding precisely when to add to your position, when to let it breathe, and when to walk away. The timing of your scaling decisions carries more weight than the entry itself, and in the next few minutes, the real transformation in your trading journey happens when you start asking yourself one brutally honest question before every single trade. Am I waiting for confirmation, or am I just afraid of missing out? Because here's the hidden truth that separates traders who capture massive wins from those who constantly get stopped out. Most people enter positions based on fear disguised as confidence. They see a setup forming and their minds immediately jump to the potential profit. They imagine what that move could become, and suddenly they're not analyzing anymore, they're fantasizing. That fear of watching the trade run without them becomes so overwhelming that they abandon their timing strategy entirely and dive in with full size, hoping the market will validate their decision. But hope is not a strategy. The market doesn't reward your ability to imagine what might happen. It rewards your ability to respond to what is actually happening. When you start with a small position, something profound shifts in your mindset. You're no longer trying to predict the future. You're testing it. You're sending out a probe to see if the market agrees with your thesis. And This single decision changes everything about how you experience the trade. There's no desperation, no anxiety about being wrong, because you haven't committed enough capital to hurt yourself. What you have committed is enough to learn, to observe, to gather real-time evidence about whether this setup deserves more of your attention and capital. Now, I want to go even deeper into this concept of how winning trades actually behave, because this is where the revelations start to unfold. Pay close attention to the difference between a trade that's working and one that's struggling. A winning position moves with conviction. It doesn't second-guess itself. It doesn't pause awkwardly at resistance and make you wonder if it has the strength to push through. It acts decisively. The price action feels clean, almost effortless. There's a rhythm to it that tells you the market is in agreement with your direction. This behavior is your signal, your green light that says it's time to add size. But here's what most traders do instead. They add to positions that are hesitating, stumbling, or moving against them, desperately hoping to average down and rescue a bad decision. This is the journey from small gains to devastating losses, and it all comes down to timing your scaling decisions based on evidence rather than emotion. If you're serious about mastering timing strategy, go ahead and subscribe. I'm here to bring you content that actually challenges the way you think about trading. The impact of understanding this distinction cannot be overstated. When you add to strength, you're building behind momentum that the market is already creating. When you add to weakness, you're fighting a battle the market has already shown you you're losing. Write in the comments, "I add to strength, not weakness," if this resonates with you. There's something fascinating that happens when you start trading with small positions. They become a mirror reflecting every flaw in your decision-making process. Most traders never realize this because they're too busy focusing on chart patterns and indicators, but the real revelation comes when you understand that every small trade you take is actually a psychological test. Are you checking the price every 30 seconds? Does a minor pullback make your stomach tighten? Do you feel an overwhelming urge to add more size just because the position moved a few ticks in your favor? These reactions aren't about the market, they're about you, and they expose the hidden truth behind why most traders struggle to turn perfect entries into massive wins. The mindset you bring to a small position is the exact same mindset that will sabotage you when real money is on the line, only magnified 100 times over. If a tiny position makes you anxious, imagine what happens when you're trading with serious size. The fear doesn't disappear, it multiplies. The impatience doesn't get better, it intensifies. This is why starting small isn't just a risk management technique, it's a transformation tool that forces you to confront your own emotional patterns before they destroy your account. When you can handle a small trade with complete emotional neutrality, observing the price action without attachment, without hope, without fear, you've achieved something far more valuable than a winning trade. You've developed the psychology necessary for sustained success. Now here's where the journey gets truly interesting. You don't need to start big to end big. That's the lie the trading industry sells you, that fortune favors the bold, that you need to risk big to win big. But the behind-the-scenes reality of every legendary trader tells a different story. They started correctly, not aggressively. They let the tape whisper its intentions, placed a small probe to test those whispers, and then, only when the market confirmed they were reading it accurately, did they gradually layer in more size. Notice I said gradually, not impulsively. Not because they felt lucky, not because they convinced themselves this was the trade. They increased their position only as fast as the market invited them to, treating each addition as a response to evidence rather than a reaction to emotion. This is the fundamental impact of understanding timing. It removes the guessing game entirely. You're not predicting where the price will go. You're watching where it's actually going and deciding whether that movement deserves more of your capital. The market shows you strength, you add a little. It shows you more strength, you add a little more. It hesitates or reverses, you stop adding or exit entirely. It's simple, mechanical, emotionless. Put down in the comments, I respond to evidence, if you're committed to making this shift in your approach. Let me ask you something that might make you uncomfortable. When you enter a trade, are you actually responding to what the market is showing you, or are you responding to what you desperately hope the market will do? Because there's a massive difference between these two decisions, and it's the hidden truth behind why some traders consistently capture massive moves, while others keep getting shaken out at exactly the wrong moment. The traders who disappear from the markets, the ones who blow up accounts and walk away convinced trading doesn't work, they all share one critical flaw: they try to impose their will on the market. They have a timeline in mind, a specific expectation of how the price should move. And when reality doesn't cooperate with their fantasy, they either hold on stubbornly or exit in frustration. But here's what changes when you embrace this timing strategy of starting small. You stop forcing anything. You stop demanding that the market validate your analysis on your schedule. Instead, you become a listener. You're reading the behavior of the price like you would read body language in a conversation, watching for hesitation, for confidence, for weakness, for strength. The stock begins to tell its own story through the way it handles support levels, the way it pushes through resistance, the way volume accompanies its movements. And you're not interrupting that story with your opinions or predictions. You're simply observing, gathering evidence, letting the price action reveal whether this setup deserves more of your attention and capital. Now, when you manage a small position with this level of awareness, something remarkable starts to happen. The position begins to grow naturally, almost organically, like a snowball gaining momentum as it rolls down a hill. But notice the distinction here. You're not pushing that snowball. You're not adding size because you're excited or because you think you've figured out where the market is heading. The market itself is doing the heavy lifting. Each time the price confirms your thesis with clean, decisive movement, you add a little more. Each time it consolidates healthily and then resumes the trend, you layer in another piece. This is the journey from small probe to significant position, and it happens through observation and response, not through hope and anticipation. Professional traders understand something that amateurs constantly miss. The market must earn your commitment. You don't hand over your full capital just because you've done your homework or drawn some lines on a chart. The market has to prove through actual price behavior that it's moving in the direction you anticipated with the strength you expected. Think of it like a farmer planting seeds. He doesn't throw all his seeds into the ground at once, hoping for the best. He tests the soil, watches the weather patterns, plants strategically where conditions are most favorable. Write in the comments, the market earns my size, if this transformation in perspective resonates with you. Think back to the last time you spotted a perfect breakout. The setup looked flawless, everything aligned beautifully, and you were absolutely certain this was the move. So what did you do? You went big. You committed serious size right at the breakout, convinced your analysis was airtight. And then what happened? The stock hesitated, pulled back, and suddenly you were underwater on a position that looked so promising just moments earlier. This scenario plays out thousands of times every single day in markets around the world, and it reveals one of the most devastating mistakes traders make. They destroy perfect setups by sizing up too fast, before the market has actually proven the move is real. Here's the brutal revelation that most traders refuse to accept. Your confidence means absolutely nothing to the market. The market doesn't care how many hours you spent analyzing that chart. It doesn't care about your conviction or your certainty. It doesn't even care if your analysis is technically correct. The only thing the market cares about is price and volume, the actual behavior unfolding in real time. When you go big, based on confidence alone, you're making a decision rooted in your belief system rather than in observable evidence. You're essentially saying, I know what's about to happen, but the truth is, you don't know. Nobody does. What you can know is what's happening right now and whether that current behavior supports adding more capital. Small positions protect you from this trap. They act as your barometer, giving you a way to participate in the move while keeping your ego and emotions in check. When you start small, you maintain the mental clarity to actually read what's happening instead of defending what you hope will happen. You can watch how the stock handles the breakout level. Does it push through cleanly and hold above it, or does it fake out and collapse? Does volume surge to support the move, or does it break out on weak participation? These behind-the-scenes details tell you everything about whether this setup deserves more of your capital, but you can only observe them clearly when you're not already overcommitted. The transformation happens when you stop treating confidence as a reason to go big and start treating it as a hypothesis that needs testing. Your small position is the test. If the market validates your hypothesis through clean price action and supportive volume, then you have evidence, real, tangible evidence, that adding size makes sense. But if the price stumbles, if it acts heavy or uncertain, that's the market telling you to hold off, regardless of how confident you felt moments ago. Put down evidence over ego if you're ready to make decisions based on what the market shows you rather than what you believe. What separates a massive winning trade from a mediocre one isn't some secret indicator or hidden pattern that only the professionals know about. It's something far simpler and far more profound. It's the discipline to start every significant trade the exact same way. Every fortune-building position begins as a small feeler, a gentle probe into the market's current tone. You're not trying to predict the entire move from the very first tick. You're testing whether your reading of the market aligns with what's actually unfolding on the tape. This is the anatomy of perfect timing, and it has nothing to do with magic or luck. It's about creating synchronization between your analysis and the market's real-time behavior. If this timing strategy resonated with you, show it by hitting that like button. It tells me this deep dive content is valuable to you. When these two forces align, when what you expect to happen actually starts happening, that's when the journey from small position to massive win begins. But notice the process here. You don't jump from probe to full position in one leap. You build it brick by brick, layer by layer, as the trend proves itself through price action. Each addition of size is a response to confirmation, not an act of faith. The market moves cleanly through resistance, you add a little. It consolidates and then resumes with strength. You add a little more. It demonstrates the exact behavior you anticipated, and only then do you continue building the position toward its full potential. Now, let me share with you what might be the most important revelation in this entire timing strategy. Your opinion about where the market should go is completely worthless unless the market itself validates that opinion through actual price movement. This is the hidden truth that crushes most traders. They fall so deeply in love with their analysis, their setup, their brilliant thesis about why a stock should explode, that they forget the market owes them nothing. The market doesn't care about your thesis. It doesn't care about your research or your conviction. The only thing that matters is whether the price is actually doing what it should be doing if your idea is correct. This is why confirmation is everything. Confirmation isn't some mystical signal or complicated calculation. It's simply the market behaving the way it would behave if you were right. If you expect a breakout to the upside, the price should break cleanly and hold above that level. If you expect a trend to continue, the stock should respect support and push through resistance with conviction. These behaviors are the market's way of telling you, yes, what you're seeing is real, Yes, you can commit more capital here. But if those behaviors don't appear, if the price hesitates or reverses or acts confused, the market is telling you something equally important. Wait, don't add. This isn't confirmed yet. Write in the comments, I wait for the tape to speak, if this shift in mindset makes sense to you. Here's something that happens to almost every trader at some point in their journey, and it's one of the most dangerous traps you can fall into. You spend hours, maybe days, analyzing a setup. You draw your levels, study the patterns, review the fundamentals, and somewhere in that process, you stop analyzing and start believing. You fall in love with your thesis. You become emotionally invested in being right about this trade before the market has even whispered a hint of agreement. This is where the destruction begins, because when you're in love with your analysis, you stop seeing what's actually happening and start defending what you want to happen. The market has zero interest in your theories, no matter how brilliant they seem. It doesn't reward the trader with the most sophisticated analysis or the most detailed research. It rewards the trader who can set all that aside and simply respond to evidence as it unfolds. Your analysis might be flawless on paper, but if the price action doesn't confirm it, then your analysis is just an expensive opinion. This is the hidden truth behind why some traders with relatively simple approaches consistently outperform those with incredibly complex systems. They're not attached to their ideas, they're willing to be wrong. They're willing to wait for the market to prove them right before committing serious capital. Scaling only after confirmation acts as a safeguard against your own blind spots, because we all have them. Maybe you tend to see bullish setups everywhere because you prefer long trades. Maybe you anticipate reversals too early because you love catching turning points. Maybe you hold on to losing positions too long because admitting you were wrong feels uncomfortable. These blind spots don't reveal themselves when you're staring at a chart. They reveal themselves in how you handle actual positions. And this is where small stakes become incredibly valuable, because they expose everything about your emotional state that you've been ignoring. A small trade doesn't just test the market, it tests you. It's a mirror reflecting your patience, your discipline, your ability to remain objective under pressure. Watch what happens when you place even a tiny position. Does your heart rate increase? Slightly. Do you feel compelled to check the price constantly? When it moves against you by a few cents, does anxiety creep in? When it moves in your favor, do you immediately start calculating potential profits and imagining what you could do with that money? These reactions tell you everything about whether you're ready to handle larger size, because whatever emotions surface with small stakes get amplified dramatically when real money enters the picture. The impact of understanding this cannot be overstated. Mastering your emotional responses with small positions is the foundation for turning perfect entries into massive wins. Type in the comments, small stakes, big lessons, if you recognize this truth in your own trading. There's a single principle that determines whether you'll still be trading profitably 5 years from now, or whether you'll become another cautionary tale. And it comes down to this. The market must earn your commitment before you give it serious capital. This might sound obvious, but watch how most traders actually behave. They do their homework, they analyze the setup, they convince themselves they've found a high probability trade, and then they immediately commit their full intended position size. They treat their conviction as justification for risk, as if the hours they spent studying the chart somehow obligate the market to move in their favor. But here's the revelation that changes everything. The market owes you nothing. It doesn't care about your preparation or your confidence. It doesn't reward effort or intelligence or dedication. The market only rewards those who align themselves with what's actually happening in real time, not what they believe should happen based on their analysis. When you demand that a stock show its strength before you give it more of your capital, You're creating a filter that protects you from the countless setups that look perfect, but fail to deliver. You're making the price action prove itself through behavior, not through your interpretation of what that behavior might become. This shift in mindset represents a complete transformation in how you approach trading. Instead of predicting and committing, you're observing and responding. Instead of forcing your will onto the market, you're letting the market reveal its intentions and then positioning yourself accordingly. The stock wants to run? Show me. Prove it through clean breakouts, strong volume, decisive movement. Prove it by holding support levels and rejecting weakness. When you see these behaviors, when the market demonstrates strength through actual price action, that's when you layer in more size, not before. Never before. Now, here's what separates the traders who capture massive wins from those who constantly struggle. It's not courage or aggression or the willingness to take big risks. It's alignment. Think about the difference between a large position that you force into a setup versus a small position that grows naturally because the market keeps inviting you to add more. The forced position creates stress, anxiety, and emotional decision-making. You're constantly defending your thesis, hoping the market will eventually validate your choice. But the position that grows through alignment feels completely different. There's no stress because you're not fighting anything. You're simply responding to evidence as it appears, adding size when the market proves it wants to move, holding back when it doesn't. This is the essence of perfect timing. Moving with the tape instead of against it, building positions as trends reveal themselves rather than trying to predict the entire move from the start. Put down alignment over aggression if you're committed to this approach. If you made it this far, you're clearly serious about transforming the way you approach timing and position sizing. Most traders never get past the surface level advice. They keep chasing the same patterns, making the same mistakes, wondering why their perfect setups keep failing. But you're different. You stuck around for the entire conversation, which tells me you're actually committed to making this shift from forcing trades to aligning with the market. So here's what I'd love from you. First, if this timing strategy resonated with you, if you felt like we were having a real conversation about something that matters to your trading journey, go ahead and hit that subscribe button. I create content like this regularly because I believe traders deserve more than just surface-level tips. They deserve the kind of insights that actually change how they think about the markets. And if you found value in what we covered today, hitting that like button helps this reach other traders who are on the same path you're on. Leave a comment down below saying alignment over prediction so I know you made it all the way through. I read these comments, and it's always fascinating to connect with traders who are genuinely working on mastering their timing and psychology rather than just looking for the next hot setup. And before you go, there's another video right here that dives even deeper into reading price action and understanding when the market is truly inviting you to scale up. It's the perfect continuation of what we just discussed. Click on it and keep this momentum going. I'll see you there.